Hi there, this is Aaron Johnson with a Market Minute Update, and just wanted to kind of let you know what's going on out there right now and give you a little bit of a report. I'm going to kind of read from what I'm sending out later today. Really, what a what a way to start the week. I was out in Virginia visiting clients and family, and I was watching the markets during that time, and it's just kind of amazing what we're going through and what we're seeing in our economy right now. But if you weren't aware, the Dow dropped 725 points within the first 4 hours, basically continuing a slide that started on Friday after the CPI or inflation numbers came in at 8.6 annualized rate. So a lot of the market watchers and commentators were expecting inflation to flatten or improve a little bit last month. And there was consensus anywhere from inflation being at 8.2 to 8.4%. Inflation did hit 8.5 in March, ticked down a little bit in April, and just popped back up in May, so that we're at 8.6 now. The persistent rise in gas prices, I think, was a pretty clear signal that the CPI would remain high. The only reason the CPI in April was lower than March was because gas price increases had slowed during the month, but then they resumed their surge in May. The market's engaged kind of in some wishful thinking, if you will, believing that if inflation slowed, the Federal Reserve would pause their rising rates. The Fed has risen rates twice so far this year, moving from 0% to a 0.75%. U.S. equities were off 12 to 13% on expectations. The Fed would raise rates another 50 basis points during both their June and July meetings. These increases would have moved rates up to 1.75, at which point the Fed would pause during their September meeting. But as the saying goes, even the most carefully laid plans can go wrong. With inflation at 40-year highs and consumer sentiments at all-time lows, I think the pause narrative is really out the window now. So the big question that we kind of need to be looking at is how much more aggressive is the Fed going to get? If they increase by another 50 basis points twice and maintains the course it's laid out, we risk remaining at a prolonged elevated levels of inflation and just kind of drifting along in a stagflationary environment. If the Fed gets more aggressive, markets will sell off even more and will drive the economy more toward a recession. This time last year, we were talking about 2 to 3 interest rate hikes this year in 2022. And so far, half of those are already behind us. And there's still talk of many more rate hikes by the end of the year. So the volatility will persist until we get kind of a new plan from the Fed on Wednesday, tomorrow. Following this week's meeting, which should include details about how they plan to fight inflation. And if the actions aren't appropriate or overly aggressive, we'll most likely see a continued sell-off in the markets. And I just want to reiterate, this is why when Dwayne and I are doing financial planning, we do allocate toward those protected accounts, because we want to make sure that if your income is coming from your investments, that it can basically come from that protected side so that your income won't be affected by the market volatility. And we know markets are crazy, and markets, big areas of the market are down right now. Typically when we see bonds going down, stocks would be going up, and also the inverse. But this year, there's really no safe place to hide, whereas everything is just kind of is going down. We do believe in diversification. It seems like large value clients are doing better right now, we have that in most of your portfolios. But if you do have concerns, please give us a phone call. Our number is 951-244-6702. And until next time, have a good day.